Hey everybody, Chuck Barone. Thursday, February the 9th, 2022. Big day today. Moving closer and closer to Super Bowl, to Valentine's Day early next week. A lot of good stuff coming up. Not a lot of good stuff in these markets today though. Before we get into the show, as always, we want to welcome everybody to the show. We appreciate your guys' support. Thank you guys. What you do for us every day, it means the world to us, guys. Thanks. Markets today, well, we had some data today the markets didn't like so much. So stock market down across the board today. Not a very good day for the market. It never really did. It started out kind of flat along them, and then it just kind of drifted down the whole day. Not a lot to be enthusiastic about in the stock market, even though earnings are still coming in great. The jobs news today, lots of uncertainty now. Dow dropping 249 points, rest of the market down with it. Not a great day for stocks. Bond market, well, the bond market sold off too. Not in a way like the stock market did, and then nothing dramatic in the bond market today, but yields climbing again. So you got the 10-year now sitting at 3.68%. That's up 3 basis points. The 2-year climbing 3 basis points as well, 4.48%. This bond inversion is still crazy big. We're going to talk about that a little later in the show. The dollar today basically flat down, very small. 103.26 on the index, basically where it's been sitting. Dollar looking pretty strong right now. We'll see. I think that there's a chance the ECB looks like they're about to get pretty aggressive. Might get some strength in the euro from that. We're almost ready to get the play I talked about, probably about, 6 months ago, maybe even a little less, about buying a few euros. Chances are they were selling at that point at parity with the dollar. And I thought you could get a pretty easy 10% return on that. It looks like that's about to happen any second now. They were at 109 and change last I saw. ECB, pretty aggressive talking. Now we'll see if they do it. Might get a chance to get out of my euro play with a nice 10% gain in even less than a year. Nice. Metals today down. Not a good day for metals today. Gold dropping $14.50. 1,891, now dipping back under 1,900 per ounce. Silver down 36 cents, $21.94. Now they're back under $22. So they're breaking some support numbers here, which those now will turn into resistance. We'll see if there's going to be much resistance here. I think any move down in the dollar, you're going to see metals rally pretty sharply. Oil today down again. Down 83 cents per barrel, $77.63 for a barrel of your West Texas Intermediate. Oil's just kind of sitting here. It's, trades up a little bit one day, trades right back down the next. Can't really get any momentum going anywhere. There's not a lot of news in the market to drive oil prices higher right now. People have recession fears. So with that, with that kind of thought process right now, recessions typically call for less demand, not only for oil, but everything. So they're thinking that demand for oil might stay down, helping keep prices down. Bitcoin today, not a great day for Bitcoin. Most of you crypto people, guys in the crypto market in that world, know about the news with Kraken today. It looks like there's going to be more intervention in this crypto sphere with the government. Bitcoin today drops over $1,000, $21,874. Looks like it kind of dragged the whole crypto space down with it. It doesn't seem like we're getting much good news there. It seems like the believers still want to buy, still want to have this rally. But the news we're getting in the Wall Street Journal, not showing good signs ahead for the crypto sphere. News you guys need today, the big news of the day, of course, we've been waiting for this all week. Jobs. Man, this is the word right now. The claims actually coming in worse than expected today at 196,000, up 13,000 from last week. They were expecting 190,000, so it's a worse number than they thought they were going to get. But the truth is still a very strong number, guys. I mean, it's still really strong. It's just less strong than last week. Last they were expecting 235,000. They got 190, which was a jolt to the market. Now they're at 196, and the market wants to celebrate that, like the Fed maybe going to have a little bit of relief. I think, if anything, this number is reinforcing the Fed's message about employment, and I think it's going to force the Fed, because this is the main driver right now, at least the way it's playing out. We'll talk about that here in a second, but the labor market, pretty thin for what companies are looking for, apparently. I know there's a lot of openings, and there are people looking for jobs that say they can't find them. Must be a kind of a mismatch between the skills they possess and what companies are looking for. I was reading today, companies are complaining right now that they're unable to find and hire qualified labor. They said the supply of labor is very thin. So now what this does is it puts those kind of phrases are the phrases that drive wage gains, right? So if two companies both have an opening for the same basic type of job, and that labor pool is thin, and there's somebody with some talent, these companies are going to probably be willing to pay that talent a little extra to get them and keep them, driving wage gains, driving services costs higher, driving inflation higher. So this jobs market, not really giving much relief. I don't care. The market can interpret it the way they want. I'm going to interpret it the way I want. This number just reinforces what I've been telling you guys and what I really believe, that the Federal Reserve is going to raise rates higher. We know we're going to get above 5% on this overnight rate. We'll see what it does to the inversion, but it's signaling recession coming. They're going to keep rates higher even in the face of this recession, because they're determined to have this inflation number down. And they learned in the 70s. You declare victory too soon, you start to, even pausing is not so great, but especially pivoting back and cutting rates to support jobs or support the economy only gives you what they called stagflation then, with crappy jobs market and a stagnant economy. And it's still inflation, and actually inflation coming back at worse numbers than when they start. So the Fed learned some stuff from that. Now, whether those lessons actually really apply today, well, it looks like they're doing pretty good with that so far. I don't know. I think it's a different world today than it was in the 70s, and we'll see if the old Volcker playbook in its entirety works and gets it done. If it does, well, then we kind of know how the Fed will be treating any future inflations, if there are any, because they're certainly going to know the methods that work to keep those inflation numbers down, including, I'm guessing, fudging on numbers a little bit. Prices today, we're talking about prices in this inflation numbers. Prices for goods, okay, falling 1% in January from the previous year. So they're calling it disinflation. I call it deflation, because it's kind of like letting some of the air out of the balloon or the bubble. But prices for goods falling. It's the 5th consecutive drop in price measured for goods. The problem we're having with this inflation, however, is services are still rising pretty quickly. What's causing services to rise? The cost of services to rise, of course, is wage gains. Services needing to pay more to get qualified people. Services needing to pay more to keep the people they already have on the books. These wage gains driving the cost for services higher, of course, driving the inflation higher, even with the cost for goods coming down. Now, the nice thing is, guys, in my world at least, the cost for goods to me is more important and more, you're going to notice that more than the cost for services. A lot of the cost for services that they're counting in this inflation are restaurants and bars and taverns. And I'll tell you what, man, if you ever go out and buy cocktails anymore, it's not an inexpensive proposition anymore. It's expensive to go out and drink These costs are all being driven up by the cost of labor. So you want to know why your martini costs $16? Because the bartender wants to be able to pay his rent, guys, okay? So anyway, the economists, now, so you got this mixed bag in these inflation numbers, but economists are expecting CPI, when it gets released next week, we're going to get the CPI number next week. They're expecting it to come down and to continue on its way down. So we'll see. I think that, it would be good for everybody if the CPI numbers continue to fall. It would be great if we could get into the fives or even into the low fives. I don't know if it's going to fall anything like that, but I think it was 6.1 last month. So if we get into the fives, coming from a peak in the nines, well, that's showing that what they're trying to do and what they've been doing is working on these numbers, and we'll see if they can finish the job before the recession hits. The economy giving mixed signals, everything's mixed. Fascinating times we're living in, guys. This is like living in history, and we get to really be a part of it and witness it in the minutiae even, Now, this was an interesting article today I was reading, and I love the history of this. I spent a lot of time going back and trying to do a little bit of homework on the 70s and the 80s inflation, trying to see how what they did then, for good or for bad, is relevant to what they're doing today and what they're trying to do. But this caught my attention today. Today, the bond yield inversion, I've been talking about this pretty regularly. This is when you have short-term rates higher than long-term rates, right? So usually when you're looking at a chart and it's a bond chart, and you're looking from your left to your right, it typically goes up because if the left side is the shorter term, right? So starting with overnight, the Federal Reserve, going all the way out to 30-year Treasury bonds. Typically, as you go further out in time, the yield gets higher to offset risk because you don't know what's going to happen 5, 10, 15, 30 years down the road. Well, now we have it the exact opposite way. So now you have overnight rates higher than 30-year rates. The whole bond market is signaling recession. That's what this inverted yield curve means. Now the inversion today, I've been talking about the wider the inversion, typically the bigger the recession. It's not always 100% correct. So it's not always where every time there is an inversion, there's a recession. But the opposite is true. Every time there's a recession, there was an inversion that preceded it, if that makes sense. So now, the inversion actually, during the trading day today, hit 87.3 basis points. That means the short-term 2-year bond was trading 87 basis points on the yield. So if the 10-year was at 3%, the 2-year was at 3.87%. Okay? That is the biggest gap, second biggest gap in history, okay? They're really afraid that they could break the record set in 1981 and could even pass 100 basis points on the inversion. Now, the most recent record, the closest they've gotten to the 1981 record, was an 84.9 inversion set back on December 7th of last year. Okay? 84.9. So today it hit 87.3 before falling back. The all-time record. Now this was set in 1981 at the peak of the big inflation, 96.8. 96.80 basis points, almost 97 basis point inversion. It's never hit 100 basis points. That record was set on October 2nd, 1981. Interest rates at that time were 19%. The inflation rate was right around double digits. It was that inversion foreshadowed a pretty serious recession in 82, 83, before the economy really rallied and rebounded and went on to be a super strong economy for pretty much until the dot-com bust, right? So hopefully we kind of get the same result here. If we're going to have a recession, it looks like it's going to be a pretty stinky one. Probably not the super longest lasting recession, but it's going to be painful. So a lot of these job gains we're getting, we're going to give them back. Just like we're giving back a lot of the gains we had in house prices. But fascinating stuff happening right now, you know. It's easy to look back at your life, you know. It's like, okay, I was alive in 9/11, for example. You're living history. You're seeing it with your eyes. You're actually alive and part of it. You know, not a lot of us were alive in Pearl Harbor, or, you know, a lot of us weren't even alive when JFK was assassinated. These things do not happen with any kind of regularity, what we're living through now. So learn from it, guys. You know that this is a very unique time in our history. And the good news is we have a little bit of the past to look back on, which gives us an idea of what we can get going forward. And I think we've been pretty much spot on telling you guys the very basics are what we need right now. Too much confusion to try to be very clever. If you've been listening to what we've been saying over the course of since we started this show back last year in June, you guys are doing pretty good. Anyway, that's it for today, guys. Crazy day. Jobs, jobs, jobs. We'll be back tomorrow to wrap this week up. Hopefully, maybe we'll get a little positive data. Super Bowl weekend coming, guys. Anyway, we'll be back tomorrow. Till then, take care. Thanks.